One of the metrics not talked about enough inside of most businesses is quality of earning. And whether you're looking to be more profitable, or you're looking to scale, or you're looking to sell in the future, what can you do about quality of earnings? How does it help you and why does it matter? This is a fantastic question. I'm Scott Sylvan, coming to you live from Consulting Secrets on a perfect day to talk about business, growth, opportunities, selling, maybe, and a fantastic day to talk about you. I'm coming to you live from Haleiwa, Oahu. Today's a fantastic day, a little bit windy, a little bit breezy, so I'm shooting this from the inside of my car. So if you're like, hey, Scott, what is quality of earnings? So let's just say that you take Excel Eddie and Excel Edwina because they excel at what they do, and they take a look at your books, right? They're not doing a cursory look like an accountant would. What they're doing is they're going column by column and saying, hey, what is the most profitable line of your business? What's the least profitable line of your business? If you got a sales team, this works for your sales team too, as a side note. And it's not your revenue number, it's the defensibility of your profits, right? You can make a matrix of where do your profits come from. A lot of people, when they take a look at the end of the year or the end of the quarter, whenever, end of the month, they're like, okay, so we had $1 million in sales and $100,000 of profit. We are 10% profitable. Like, no, quality of earnings report, what we're going to do is we're going to break down each individual item to see, like, is this really truly profitable? And one of the things that you're going to find is, and not every time, but sometimes you're going to find that one of the lines that you thought was the most profitable could be the least profitable. And one of the lines that you thought was the least profitable could be the most profitable. And this is important when it goes to sell, because if you're talking about quality of earnings and you're using a 5, 4, 3, 2-year process, and you're able to prove quality earnings on year 5, 4, 3, and 2, and you're saying, hey, this is my history because that's how companies sell and I want the max multiple, then you have the ability to take a look at the information. Because when you go to sell, the buyer's version of Excel Eddie or Excel Edwina, they're going to look for the items that shouldn't be added back. They're going to look for the wrong add backs, the one-time expenses, the owner perks that are ran through the business. Like, it may be trips, it may be masterminds, it may be that emergency trip to Tahiti, right? So one of the things that happens is buyers may take a look at your numbers, and you were at $20 million a year with a $4 million profit, so 20% profit. And then they take a look and they go, wait a minute, time out. There's a bunch of stuff that you added in here that is legal, right? For accounting and for getting it past the IRS, it's legal, but it doesn't prove profitability inside of the company. It doesn't prove profitability inside of the organization. So what we're going to do is we're going to give you dings and dents on all of these. And they may get all of them. They may get some of them. It depends upon how good their team is. But I've seen on my side where people start stuffing, right? Add back stuffing. Add back stuffing is where it's just like everything under the sun is thrown in there when it's not supposed to be. Everything that you could imagine. But what ends up happening is that builds doubt. That's like, okay, so if you got problems with these numbers, what else is going wrong? So what you need to know is this will be considered an adjustment between EBITDA, earnings before interest, tax, depreciation, and amortization. And what you end up with is your adjusted EBITDA. Like, they're like, hey, this is really where the business is profitable. This is the true profit. This is the true amount of money that your company makes. Hey, you say that you have a $20 million a year company making 20% profit. Time out. Like, that's not the case, because we went through your add backs. We went through your one-time expenses. We went through all of your owner perks, and it was $500,000. So now you're at 3.5 million. And let's say it was a 6 times multiple. They just took $1.8 million off the books for you. Like, if you're paying yourself $200,000 a year, you start doing the math, that's real money. That's real adjustment for you to say, wait a minute, I was hoping for a beach lifestyle. Hey, Scott, you're out in Haleiwa. Let's talk about the beach lifestyle. Let's talk about the beach retirement. We could do that. If you're after the maximum multiple, what you really want to start doing is, and talk to a qualified professional, right? You're watching some guy on social media, but figure out what you're going to have to do to get your quality of earnings to be bulletproof 5 years, 4 years, 3 years, 2 years out, so that when you say, I want the max multiple, everybody else in this industry gets an 8, right? I want the A+ deal. I want a 12. And they're going to say, we might be able to do that. What kind of proof do you have to support what you got going on? And then you pull out your quality of earnings report signed by a CPA, a major firm or a mid-level firm. And you're like, I got my information right here. And it's one of the things that, okay, for 3 years in a row, 3 years running, you've got a Q of E, a quality of earnings, and it's signed off by a high level or a mid-level CPA firm, that puts them on the line. That report puts the CPA or the CPA company on the line. But be aware that this is a question that you can ask your accountant today. Like, hey, if we took all of these add backs, where would I be on profitability? And for some companies, I mean, it could be as much as 25%. For some companies, it could be a huge freaking number. And you don't want that. And you don't want to do stuffing. You don't want to stuff add backs to try to make it look good, because once again, there's somebody who's amazing with a spreadsheet that's going to be like, that's not there, that's not there, that's not there. We're going to ding, 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 dent, dent, dent. And you could easily lose a couple $1 million, because it's not your fault you didn't know, but it's now that you know, it's your responsibility. I learned that from John Benson, amazing copywriter. One of his favorite sayings, one of my favorite sayings. It's not your fault you didn't know, but now that you know, it's your responsibility. So if you can, and it's going to cost some money. Like, don't get me wrong. For a mid-level firm, it might cost between $40,000, $60,000, $100,000. But you got to look at it as an investment, because here's what's going to happen is when you go to sell and you're like, I want max multiple, and you're saying I got an A+ deal, and you're asking for 12 times multiple in the market where everybody else is asking 8, and you've got proof and you've got history, that's your defensive moat. That's your ability to say, I've got quality of earnings reports. I don't just have my books, I've got quality of earnings reports. And you're gonna see whoever's on the other side go, yes, right? And then they're gonna say, well, you got the history, you got the books. And if you ever take your company for sale and you want to put it up and you want to put it like into an auction, these are the types of things that help you win and get the max multiple or that A+ deal. I can't guarantee that you're going to, because I don't know the ins and outs of your deal. But I can share with you this, that when you start having things like quality of earnings reports, and they're done on a consistent basis, and you don't have all these wacky add backs in, or you have them in there, and then when you go to sell, you're like, these are the things I'm going to pull out because we're not going to put them in there. We're going to adjust it ourselves. You could do that too. You got 1 of 3 things to do from here. Just 1 of 3. Find the subscribe button, click on it. Every time I send a video, you'll get an update. 2, hit follow. 3, share this video with a friend. We'll see you soon. Thanks for watching.